I work a lot from my convictions, a lot more than I previously used to, because when the signal comes, the real one, everything happens so fast that you don't have time to react. Either you are early or you're late. But being timely, I find, is now very, very difficult. That's it. You have to act on your convictions. If you're wrong, things go slow. But if you're right, things go fast.
Welcome to Cycle TV. On behalf of the Foundation for the Study of Cycles, your host, Ron William, Development Director. I'm excited about our next discussion interview with Valérie Gastaldy. As a brief introduction, Valérie is the founding partner of Day by Day, graduated from ESSEC in 1985 to join immediately France's largest broker at the time. She has various leading roles within the market thereafter. My most interesting insight in her career experience is witnessing the 87 crash and the 2000 bubble. Of course, in terms of how change is possible, especially when it's dramatic and impactful, and how she felt the urge to understand the causes of market excesses, as many of us do after the fact. So as a consequence, behavioral finance was a natural answer to her journey and quest. She developed a three-stage approach, which is what we will focus on during our session here with Cycle TV, to market analysis, combining long-term cycles to frame the economic background, sentiment evaluation, ultimately to pinpoint reversal risk, and tactical chartism to identify triggers. The method allowed her to beat all sell-side fundamental analysts, which is always a way to differentiate, but also at the key cycle points. We're seeing right here and now, 2025, a big non-consensus year already within the first quarter. So timely for us to be having this discussion and to be looking on the point of cycle application. And her main forte during that time is European equities for 3 years in a row in terms of the track and the success during the turmoil of 2008. And then just to complete, a founding partner at Day by Day. She is in charge of market strategy for institutional clients. She also teaches technical analysis to MBA students at SKEMA Business School. Valérie, as an industry colleague and friend, I welcome you to the Foundation for the Study of Cycles and our Cycle TV. Great to have you on the show.
Hello, Ron. Thank you. I'm very excited to, let you know a little bit about my work.
Wonderful. And I have to begin with a thank you for making the time, and with such tumultuous market volatility. We're all on the edge of our seat, waiting for the market ball to flip another time. And as someone just told me yesterday, the market is moving faster than the headlines.
Yeah, it's moving so fast. You don't, This morning I opened my charts and I started looking at the indices, and then I sort of got a few ideas, and then I moved to my equity charts, and by the time I was there, all the levels that were interesting to trade were already off, because we had moved by 5% or 6% in half an hour between just the open and my thinking being ready to act. So yeah,
absolutely. It's
I wished I was a computer.
In due course, post session and in the days and weeks ahead, there's the old saying that sometimes a few days can be like a few years, and vice versa. Clearly, we're in the former part.
And vice versa.
Maybe on that point, if we begin top of mind with all the market vol that's going on and the crazy headline news that keeps changing, but also the noise that is compounding over time, where it becomes difficult to identify signal from noise. and more importantly, to stay on track with a clear, actionable strategy and to manage the risk in a way that makes sense. What's your initial experience and guidance for those who are going through similar things? What worked for you? What's the best practice that has stood the course of time?
Um, I I don't think there is that much noise in the market. Um, when looking at the most liquid contracts, and really most of my time I focus on the S&P, stock 600 or Euro Stocks 50, T-note, Bund, Euro dollar, dollar index, and I don't think there is much noise there. I think that the main problem is that there are so many algos that just change their minds in the fraction of a second. And when an algo has changed its mind, uh, it goes very fast. And what used to take place over a couple of weeks now take place over a couple of hours.
Right.
So this is what is really very difficult, is that it's impossible to work intraday horizons when you are working by hand, okay, or by the eye, by the end, by as a human being. um, and it's even becoming difficult when you are working from weekly charts and when your usual time frame will be a few months, because what occurred like yesterday evening for me, I'm in Europe, right? I don't know whether people who are listening will know. When I say yesterday, it means it was on the 9th.
April.
What occurred on the 9th of April when tariffs were posed,
Yeah, this is
and
literally live
markets were
post
by
announcement.
10% up. If I refer to markets at the end of the 90s or even until 2011, 2015, something like that, I think it changed a lot between 2015 and 2017, something like that. It could have taken some 2 weeks, and it was half an hour, maybe less. I mean, if a few seconds to jump 6%, and then a couple of hours to jump 10%. So that's what is very difficult. So also, what I think has changed a lot is that you have to. I mean, I work a lot from my convictions, a lot more than I previously used to, because, and this maybe relates a little bit about to the question you asked about signals, because when the signal comes, the real one, everything happens so fast that you don't have time to react. So it's very difficult because the market is testing badly, but like since November, December, I really thought that I had everything that was mature for the market in the United States to reverse. And those were my conclusions for 2025. I said, okay, we don't have a signal, but it's going to be very tough. So my model portfolios, I switched volatility down. I went to very conservative choices. And it's hard these days to find conservative choices because, for example, healthcare is not a defensive sector anymore. Just an example,
Yeah.
right? Anyway, I didn't look at the performance of the portfolio just now, but I was up 18% before at the end of last week. So it was working up to last week. But I had to do that, and without any signal, because either you are early or you're late. But being timely, I find, is now very, very difficult. So that's it. You have to act on your convictions. And the advantage is that if you're wrong, things go slow. But if you're right, things go fast.
Right.
Like,
It's
when you get ready for the market to fall, a fall is always fast, and it is, these days, it's just in the blink of a second. Um, but on the other hand, when you get ready for the market to fall, it means that the market has already risen a lot, and it doesn't have much potential to rise fast anymore. That's the reason why all the cyclical indicators are topping, all the sentiment indicators are topping, and everything. So the market doesn't have more. It doesn't have any kick to the upside. So if you're wrong, you will have time to adapt. And if you're right, you have to wait until you're right.
it's a great point that you make, and one that I can only imagine builds over experience when you've tried and tested and ultimately evolved and adapted the practice. And also, the same point that you make says something about the nature of markets and the cycle that drives markets. It's asymmetric. It's the mountain climb up, it's
Yeah.
the cliff drop down, right? And
Usually it's slow to rise.
yes, with
It wasn't yesterday.
I think typically the rule of thumb: equities driven by greed on the upside, fear on the downside. Some make the case that commodities flip and tend to have spike tops for that reason. But
Yes.
certainly within
Yeah.
the traditional markets, equities and macro in general, like you say, steady on the way up, but fast on the way down. And that's the relationship between greed and fear, the asymmetry between the two. And certainly as part of the cycle framework, which you use and others will do too, uh, things change pretty quickly and dramatically once we're in that late cycle stage and we're beyond the inflection point. If I can play on your early experience in the market, as just spotlighted when on the introduction, 87 was an aha moment for you in terms of big change and insight, along with other event risks that you experienced. Can you walk us back to that time in your memory and share a little about what was it like? How does it compare? But also, how did that then pivot your thinking to behavioral finance and cycles? It's always good to capture the backstory and the journey.
Well, in 1987, I had started technical analysis about a year ago. And 1987, we had plenty of sell signals, ample time to sell, really, before Black Thursday, because Black Thursday was a C wave in Elliott terms, and the sell signals came during the A wave. Obviously, what you never know is that you're going to fall that much.
Of course.
Okay. But I was out of the market. I was not invested anymore. And I was ready for a reasonable fall. That's it. This is not when I didn't have a conviction that I had to use other tools at that time. I developed cycles when I went to the what is it called? The IFTA meeting in London in 2002.
And
And there I listened to Tony Plummer for the first time.
and if I may,
And this was awesome.
if I
I was,
if I may, as a reference point, IFTA, the International Federation of Technical Analysis, it's the global body for basically the discipline that many apply for chart analysis, for market timing, behavioral finance, and of course, as part of their annual flagship conferences and some of the local societies here in the UK, where I'm speaking from, there are many pioneers in the field. Tony Plummer being one of the well-known cycle practitioners, that's
Mm.
shared insights many times over the years and is published in the subject. If you can go back to that point, I just wanted to preface that for people listening in, wanting to know more. So you flew to
Yeah.
the UK, you attended the event,
Yes.
and
Mm.
it impacted you in some way.
Well, yes. I had studied cycles for the exam, for the STA exam, but I did not really use them much. And this is when I don't know how come, but I started receiving Tony's work not long afterwards. And I read his books, and I became friends with him, and he taught me so much, because I was able. There are not so many people who are interested in cycles, and there are not many people who are ready to really dig into cycles and do the work, because I do the work on an Excel file, and I have to manipulate large amounts of data, and I am not at all. I'm very bad with computers. I can't even do a macro in Excel, so it's all hand done, hand adjusted, um, and it's a pain, but it's rewarding.
Back to your point about being introduced to the cycle approach through IFTA, the Global Technical Analysis Association, the local community within the UK. Of course, you're based in France and part of AFAT, the French equivalent of IFTA.
Mm.
But back then, the UK was very active on the education side and had many of the leading pioneers in general, including cycles. And Tony Plummer, who's a prominent cycle figure, published in the subject, and we can touch on his work as part of how it then evolved into the work that you do now, along with additional practices that you apply. If we can begin at the
Mm.
cycle itself, so
Yes.
to have that kind of visual foundation reference. This is the one that we start with. We can maybe discuss more now or on future occasions. On first glance, we have a triad cycle, and I'm just going to read it
Yes.
as anyone else would be as they watch our discussion. Base cycle, trend cycle, terminal cycle. Now, Valerie, I will ask you what many other people will be asking. So you and I know this cycle.
Yes.
You know it well because you it's part of your process, and it's part of the work that you now do. And I know it through books that I've read and presentations I've attended of Tony Plummer. But to people who are looking at this for the first time and they're thinking, what is the basis behind it? One, and two, why three? And what's the framework that helps explain this in your own experience and words?
Mm. Right. It's important. First of all, maybe all of you already know, but um, people who come from physics, they think about cycles as going up, down, up, down, up, down. So they see the cycle as a two-phase or a four-phases mechanism. If you do so, when you add cycles from different time horizons, then your addition means that in the middle of the largest cycle, you will have a very tiny amount of vibration, because you've added things that are divided into two, and in the middle, therefore, it will always be the middle of a cycle is always zero. It's because it goes up and down. So you have to have a cycle that divides into three different parts, so that when you add all those three different parts, each time you add a sub-cycle to the previous one, the middle of your cycle keeps growing every time, and it's always higher than the other parts of the cycle. You have to do a little scheme and to add different cycles together to have that experience. But it's very important to have those three parts of the cycles. And what Tony says is that each of those three subcycles, or it's the same to each cycle can be subdivided into three parts. So each subpart is a subcycle, but in itself, it is a cycle that can also be subdivided into three parts.
Yes.
Okay, there is an infinite. No, you can't do it an infinity to the infinity, but you can do it a few times. So each of the three cycle has a different name because they have different characteristics. Um, when you have the first cycle is laying the layers for the development that will come in the main part of the cycle, which is called the trend cycle. And the last part, called terminal cycle, is the one that will have to erase or correct what has been done during the first two phases. So the base cycle is supposed to have a top that is roughly in midway in time in the cycle. You know, it happens after in the middle of the overall time span of the cycle. The second cycle, the trend cycle, which develops the most power, has a late top, which will probably happen at 2/3 or 3/4 of the overall time of the cycle. So the top is really moved to the right. And the terminal cycle usually has a top that moves to the left, but you always have to be very careful because we work on when we draw those schemes about cycles, we draw on speeds, and a top, a very high top on speed that occurs very over a very short period may not lead prices higher to a top on speed that may be at a lower level but has been rising for many years. Because if you take 50% in 1 year, or if you take 5 times 15%, so 15% 5 years in a row, you know, your peaks will be very low because you will go up to 15% and you will stay there flat for 5 times, for 5 years consecutively. Whereas the previous peak will stand out at plus 50%, but just once. But actually, prices will be much higher when you reach the second top than when you reach the first top. Okay,
Understood.
so it's something that people tend to forget when they look at the cycles. Um, you know, minds are used to working on prices, but you're looking at speed. And this is very, very tricky because you cannot derive price from speed, because to make, you need something else to derive price from speed. You also need to have a precise projection in time
You
of
make a
the various speeds are
you
going to be composed.
you make a very important point there, Valerie. And if I can spotlight that point, because it's very important, but also typically uh, misunderstood or even understated.
Yeah.
And so that's why it'd be good to build on that. Often when we look at a cycle, we think more, even though it's time based, we think in terms of price projection. But one of the things that
Yes.
I think many practitioners, I think over time realize, it's the time pattern, as you quite rightly highlight, but also the speed or the rhythm of the time pattern. And of course, that while it still is useful, that implication is a different variation on price only. And of course, by definition, we're talking about rate of change. So it can mean
Yeah.
different things. It's not just a binary outcome, up or down. It can be quite complex.
It's higher than 12 months ago, or 6 months ago, or 2 years ago, depending on the rate of change that you are using. It just tells you that you're going up or you're going down relative to a certain period. So it's very tricky. I have made many mistakes because of that, and I think that many people do make that mistake. So that's why I wanted to raise your attention to that specificity.
Thank you for the clarification. And to recap for our audience listening in, uh, 3 phases, part of the fractal pattern of the cycle, but also perhaps nature itself. That's a whole philosophical area that people can research and maybe aware of. But certainly in terms of the self-fractal nuance of cycles and this in particular, how they self-divide. Then the second point about skew, that clearly the base cycle seems to be a normal um, symmetrical cycle in terms of textbook cycle, whereas the second and the third trend and terminal have skew to the right, and terminal seems to be a complex mix. And this
Mm.
idea of 3 stages also as base cycle, trend cycle, terminal cycle, I was just thinking it's almost like cycles of life in terms of infancy, and then maybe the maturity, and then the aftermath, the grand finale, as we say.
Yeah, maybe. Well,
Back to markets. Where do you take this in terms of your process, but also in terms of markets here and now, and future projections? But first and foremost, how do you apply this in your own work?
um, how do I apply it to my work? Um, well, cycles are a very important part, but only a third of the job, and the one that takes the least time, really, because I don't have to assess them every day. Um, so I rely on 3 different behavioral models. Um, the first model is the longest term model, which is the cyclical model, in order to assess, to have my own opinion about what the economy may be like in the coming year, usually. And I will look at CPI cycle, US CPI cycle,
Okay.
US industrial production, US yields, and Dow Jones. Um, this is a very simple image, but I find that it's enough for me to have a good enough frame of what to expect from the economy, because the CPI will tell me how how money is moving around. Is it plenty? Is it shrinking? Is there less money available? So this already is very has a very important impact on asset prices. Second, industrial production. Obviously, in the United States, industrial production is a very tiny part of the overall wealth of the country, but it is still very important, because it is the beginning of all the all the movement in the economy, in real life economy. So industrial production is an indicator I follow Tony Plummer on that. GDP does not respond well to cycle analysis. Tony says that you have to look either at volume indicators or price indicators. Volume indicators typically is industrial production because it measures the quantity of goods that the economy produces.
Interesting.
Price indicator, you have obviously equity prices, but you also have CPI. It's the most important price indicator, CPI. And GDP is a mix of volume and price. It's not a pure indicator. And therefore, it does not respond to behavioral models because it's a little bit like yields. Yields are very hard to pinpoint with cycles because they are under the influence of both volume and price. If you think of yields, especially in the United States, the mandate of the Fed is to adjust its policy according to employment. Of course, employment is a volume indicator that will be potentially very related to industrial production. And also according to CPI, which is a price indicator. So if you look at yields peaks, or if you look at yields bottoms, peaks will usually be related to CPI peaks, whereas bottoms will be related to industrial production bottoms. So yields are very difficult to work with because they are also a sort of mixed production price indicator.
Great
I
insights.
try to use them, but
Great insights that you're sharing in terms of big picture, macro, blended with market work and cycles. And I really want to emphasize that point, if I may, Valerie, because it's increasingly the way that many traditional analysts and money managers look at markets. But within the cycle work, some are purists, others are open to kind of blending and to thinking big picture macro. Can I, on that point, if I can, what's your view on that, just so I can put it out there and share your perspective?
what do you mean? What's my view?
Puristic
About what?
Puristic technical analysis, or versus kind of blended macro, which is part of the approach that you share with us now.
Oh, it's hard to explain. I only make decisions on prices because I don't make a decision that doesn't have a stop loss. I'm a trader, basically. Okay.
Yeah.
I need to know when I'm going to be wrong because ultimately I assess that I always assume, not assess, I assume that I will be wrong once in twice because it's, being basically this is what has to happen, right? And therefore, the only thing that matters is not that I'm right, is that if I lose, I don't lose too much. My loss must be manageable, and I must be able to keep going with my capital even after several losses. And this is really major. So, in a sense, I'm a purist because I'm always guided by prices. But I'm also a human, and I think that human beings need stories to act. We need to think that we have convictions, and we need convictions. And those convictions, I build them from cycles. This gives me a comfort. Also, it's important for me to study cycles because working on behavioral models, the only thing that matters to me is to have my own view from cycle, which is factual because it's based on numbers, okay, and that's it. I listen to what strategists say in the market, right? I'm very attentive to the consensus, economist consensus, strategist consensus, and so on. I listen to interviews, and because when there is a strong consensus at the beginning of the year, it never occurs. Obviously, because everybody is already positioned for that scenario, so it cannot occur because it's already priced.
Too strong, too
And
soon, and
it's
overcrowded.
important. It's crowded, yeah. And if I have a consensus, but the problem is that when you listen to people about the consensus, they can lie. Asset managers lie continuously when they come on TV, and I listen to them on TV or on the radio. It's the same. They lie because they never tell you the reality of their trades. They tell you either about old trades or about future trades, but you don't know what is really their position now. When the market goes up, they tell you they were long, and of course they had some longs. And when the market goes down, they tell you, oh, but we had sold already, but maybe they had sold such a small fraction, but they say that they had sold already. So they lie. um, but they say what they think is going to happen, right? So it's important to listen to them, to know what they are imagining. I learn about their imagination, and I can confront it to my models. Because if my models tell me that, yes, industrial production cycle is in a part that is rising, then I think, okay, they are telling me that they are bullish, but probably their exposure is not, they are not overexposed, right? They don't have leverage to the upside to that scenario. Um, because as we all know, during a wave 3 in Elliott wave, during the trend wave, the consensus is right.
Yeah.
Okay, everybody knows that the market is bullish. It's just that people sell too early, someone else comes into the market, and the person who has sold too early is on the sidelines, and a little afterwards he will buy back because he understands that he sold too early. So you have to differentiate this wave 3, where you have to accept that the consensus is right and you want to be right with the consensus,
Biggest part of
and
the
you have to differentiate it
trend.
from, sorry, I didn't hear you.
Biggest part of the trend in terms of the long-term cycle, wave 3, and that's when the trend is typically our friend, more often than not.
Yes, exactly. But tops and bottoms, you have to go against the consensus.
Exactly.
Okay? So you have to know when tops and bottoms will occur, and cycles are very useful to have a timing for those tops and bottoms.
If I can briefly
Because
highlight that point for this year and share the slide on the screen, you can see here,
yes,
this is something I called Mind the Consensus Gap for 2025. And you can see the top left-hand chart, figure 1, shows Wall Street
yes,
consensus literally to the right side of the performance skew, but also one big spike in the middle. And that was
mm,
for an additional 10 to 20% after 2 years of back-to-back 20% already. And there was one outlier looking for a 30% correction to the left side of the tail. That's one point in terms of forecast and consensus clearly being skewed as part of that strong trend. And on the chart following that, that shows the equity market performance in general. And again, it's a reflection of the forecast itself, market performance. 2020 was a sweet spot peak. 2024 is second to that. 2019 thereafter. But the left tails were only in 2022 and 2008 where we had high vol, 20%, first, and then 40% thereafter. The last point, and then back to you, Valerie. Your point about stay wave 5, big trend is your friend. Consensus is typically right, and we actually want to trade in that direction. But at the cycle inflection points, things flip around, and we want to do the opposite. This shows the difference between consensus and returns. And you see the points, the cycle points right there, 2022, 2008, and Y2K, where consensus is very...
Yeah, but honestly, my experience is that those consensus, when people just vote, are useless. I never work with sentiment like that. Those consensus, they tell me about the imagination of the market.
Yes.
Okay. And people they invest on their dreams. Okay. They think, oh, artificial intelligence is great. I'm going to buy, all the chips that will be used for artificial intelligence. I'm going to buy cloud providers and things like that. It's a dream.
Yes.
And it's important to know what people dream about, because then I can map the sentiment, that the real one, what I really call sentiment, and what I use and what I rely on in my work is option put call ratios, because this tells me the truth of what people have done, what they have bought, what they have sold. It tells me whether they are optimistic or not. And I look at mainly put call ratios, but of course implied volatility too, and implied volatility structure when it's available, looking at 1 month, 3 months, 6 months, and see how the spread evolves. It's not a magic tools, but it's part of the sentiment toolbox that I can rely on, because the first part is really the cycle, because I need to know what reality will be in the economy, because I find that cycles work wonders in order to pinpoint tops and bottoms at very important junctures. So I rely on that, so that I have my expectations and I listen to what people imagine. If I disagree with them, if my cycle say it's going to top and they say, wow, it's great, like last year at the end of 2024, then I monitor sentiment, as I said, from put call ratios. And when sentiment shows that investors are particularly optimistic because I have reached extremes in put call ratios, then I am very careful about prices, and I wait for a pattern on prices that can be that can become a reversal pattern, right? And I will be contrarian on technical analysis tools when I have my first 2 stages coming from cycles and from sentiment, when they both tell me you have to be a contrarian. If I see a new high and then the new high is reintegrated, I assume it's going to be a failure, especially if there has been a lot of volume on that day. And we had those failures on the S&P and on the NASDAQ. And that was just so easy to spot. But for me, that was a huge signal that the movement was over. And it was exactly the top, because everything was ready and the situation had matured for this to happen. Anyway, so that's the 3 stages of that I will use. So
and just to recap,
in the beginning, you asked whether I would mix fundamentals and technicals.
Oh.
I don't hear you anymore.
Does this sound okay? Still okay? Dan?
Yeah, now I hear you,
Okay.
but I lost you for a while.
Hopefully we're back again. Dan, all okay from your side? Okay. Valerie, if you wish, we can recap on your slide with the 3 stages as a reference, if you wish.
Yeah, so we have these 3 stages: forecasting from the cycles, then assessing the sentiment, because you want sentiment to be extremely optimistic when cycles are supposed to top, or to be extremely pessimistic when cycles are supposed to bottom. And then you can use price indicators. And I look at Tom de Mark indicators. That's the only indicator I look at. Everything else is just charts and horizontal levels, to have my key triggers, but I will be I like to have a Tom de Mark confirming that potentially it's an important, you know, access also on prices. So those are the 3 stages. The first one is really very long term. Sentiment will usually give you a schedule, will help you frame the timing by a few weeks or months. And then prices are the most precise indicator, and they are the ones that will really help you manage your risk anyway. So as long as prices do not agree with the rest, you have to keep quiet and wait.
Very good. So,
So those are the 3 different stages. But you would like to see a few of the cycles.
yes, I had a quick question on the economic cycles, and then it'd be great to uh, 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 focus on here and now in terms of what your view is going forward. The brief question I have, open question, especially for all those who are applying cycles in different ways, and particularly the macroeconomic cycles. I wanted to uh, frame the work of the well-known cycle researcher. He didn't develop his own cycles, but he did study cycles. The work of Harvard professor Joseph Schumpeter, in his Schumpeter schema, he looked at 3 main cycles, which is typically used by macro cycle frameworks, including Tony Plummer's work, and also the work that I do as part of the model from my mentor Robin Griffiths. The 3 cycles on the screen, if we can spotlight. The big one, Kondratiev, impacts interest rates, but also society itself, and can lead to all kinds of inflection points in history. Jugular, sometimes mixed with the decennial cycle, but it's unique in its own right, developed by the French economists, averaging around 9 years, but sometimes people extend it to 10, also based on the economy. More specifically than Kitchen, which my understanding is originated from the UK, and sometimes gets blended with the presidential election cycle, although that's different. In the Foundation for the Study of Cycles, we refer to that as the 4-year in terms of annual year, but also the 40-month or 41-month, based on the work of our co-founder Edward Dewey. And that actually correctly marked the current top that we're still developing in markets here and now. And then lastly, seasonality in terms of the seasons of the year and how that impacts cross-asset. My simple question here, that was more just to set the stage and to offer educational reference for those who are listening. But Valerie, as a cycle practitioner, building on the work of what you had studied in terms of general study, but also under the mentorship of Tony Plummer, what's your perspective on the 3 main cycles, Kondratiev, Jugular, and Kitchen? In your own experience?
Yeah. So Kondratiev is a price cycle. It was developed on wheat prices by cereal prices by Kondratiev, and it works really well for CPI. Um, it's for the Dow Jones or industrial production, it's not so easy. This is not what I rely on. And I followed into Tony's steps, really. I did as he taught. For the Dow Jones, I rely on a cycle that's called the Berry cycle, and it's about 33 to 35 years. Actually, jugular and kitchen work together because a jugular cycle is a combination of 3 kitchen cycles plus a small introductory part that Tony calls the setup. But on the jugular cycle, it's not very visible. We can ignore it. So you have 3 kitchens, they build into one jugular.
Yes.
And then if you take 3 jugulars, it will take you up to 30, 33 years because jugular is more 10 years something. You see, 3 times 3.5 years. With 3.5 years for kitchen, sometimes there are 4, sometimes there are 3.5. So it will take you somewhere between 10 and 11 years. So you take 3 such cycles, 3 jugular cycles, and you add up that setup in the beginning that will roughly be 2 years, and it gives you a 33, 35 year cycles that is called a Berry cycle.
Yes.
And this is what we use to work on the industrial production and on the Dow Jones. But on the Dow Jones, we don't give it the name of Berry. It's just that it does work on the Dow Jones too. And that's it. And actually, yields have their own frequency. There's something on yields that works sort of every 21 years, and you can subdivide it into 3 as to a sort of 7-year cycles. So why? I don't know. As I told you, yields are something that are between price and production, and they have their own life. And the cycle doesn't have a name, but the one that I rely on is 21 years subdivided into 3 7-year cycles.
So to re-clarify, there are 4 cycles, an additional one building onto the 3 that I mentioned: Kondratiev, jugular, and kitchen. But the 4th one you mentioned is the Berry cycle, 33 years. But also, and please, for those who are interested to read more, Financials Markets by Tony Plummer is part of the reading list for the IFTA exam here and now, but also widely available and read for those who are interested in this particular cycle work, which is what Valérie is describing to us and as part of her framework. And interesting how each of those cycles relate back to different markets in different ways. It's not a one size fits all. Not all markets work with all of these cycles. There are certain correlations that exist with some, not the other. Then, of course, there's a harmonic relationship between some of the cycles. So there's a lot of important steps that people who are learning this for the first time really should take in order to better understand the framework, but then also the implications of these behavioral models and how cycles frame it up. My question to you, Valérie, as a top of mind question that many people will be thinking right now: what's your view on markets, and what do the cycles signal here and now?
Yeah. Okay, so there are some, we can start. The way I think is I always start with the longest cycle. So I usually start with the Kondratiev CPI cycle. And on all the charts I will show you, like the one we are seeing right now, you always have 2 lines. A black line, which is the average of the previous cycles. The way I find this average is that I will slice the past And then I will, for example, if the first cycle I identify lasts for 52 years, and the second cycle I identify lasts for 56 years, I will stretch both of them over a 100% scale and average each point, of those cycles. I will make an average at 1% of the overall duration of the cycle, the average speed at the 2%, the average speed at 3%, and so on. And this will give me the outline of a typical cycle, which usually lasts for 54 years, but it sometimes is 52 years, sometimes it's 56 years. I'm talking about Kondratiev, but it's the same for all cycles. You never know exactly how long they are going to be. So when the cycle works, you are blinded. You don't know you have no idea how long the cycle will be, whether it will be a shorter cycle or a longer cycle. But as time goes, you sometimes have to more information, and you can adapt the length of the cycle. It's part of the tricky bit of working on cycles. So CPI cycle, the black line is that average, but there's only 2 full CPI cycles that I can rely on for US inflation. So it's not statistically very significant. Anyway, that's what I can work from. And the red line is always the current cycle as I assess it, because I may be wrong on the starting date of the cycle, obviously, and I have different representations for the cycles. One of the things that there are 2 measures that I can vary. It's the rate of change. And here, for example, this is a 24-month rate of change, not a 1-year inflation. It's a inflation over 2 years. And the number of points that I use to make the average. And this will have an important impact because obviously the less points you have and the longer term your rate of change, the better will be the overall outline, the overall rhythm. But of course, you may not have the precise highest point of the cycle, because maybe the highest point was in between 2 dates when you were representing, okay, because you're only having, for example, 50 points of data to represent 55 years.
Yes.
So,
With such a
okay,
long
there are
data set.
advantages and disadvantages to each of those methods. So I always work on several. It's very tricky, right? It's art more than science, I'm afraid.
Yes, of course.
So that's one representation.
And I was going to say also,
But for example, this one is a 12-month. Is the 12th month.
Mm-hmm.
I lost your voice again.
But
so it looks a little bit different, but it's built. You freeze. Your voice goes off regularly, Ron. I'm sorry. Anyway, so as you can see, it was not bad. The first part was okay. The bottom was supposed to be in 2019, and obviously when COVID happened, my God, that was like woof, a massive light that came into the picture, and it was okay. Inflation is rising now, but it's going down much too much, really. It should have turned up already last year, ideally. And it's still going down because I don't have the latest point, the one that was released today, as we had the new inflation at 2.8% when everybody was expecting 3%. Well, actually, this is not core inflation. It's headline inflation, not core. So it may be a little bit different. Anyway, it should have turned up because we should have a top in roughly 2027 on inflation. And I think that all people who work on cycles agree and forecast that top. But I don't know why it's not developing yet. We should have inflation developing. So I just wait. What can I say? It's not happening for the time being. It's not happening. Maybe it means that the cycle will be much longer this time. It will not span 54 years, but maybe it will be 56. That may be an explanation. We'll see. We have to adapt later, but it's not satisfying. So that's another representation of the same with a lot more data points. And that's the sub-cycle, the 18-year sub-cycle, but we don't have so much time. So that's the first thing. It's not satisfying. Industrial production is usually my second step. And here the black line is the 3 previous berry cycles that have been averaged. And the red line is the current industrial cycle. I assume that it started in 2012. And well, we are still in the first stage. You remember those 3 different type of cycles that we can find in an overall larger cycle. We are still in the base cycle. And the base cycle is laying the foundations for the trend cycle. And as something that lays foundations, it happens underground. And not much can be seen overground, right? You think that nothing happens because you don't see the moves very precisely. And this is what we're having right now. We have industrial production in the US is very muted, and it's the same everywhere in the world. And you can see that the red line should have been rising previously, but it did not. So here again, it has not been satisfactory for 18 months, roughly.
Okay.
So let me give you a little more detail, okay? That's the focus on the juggler cycle. So if we just take the first third of that berry cycle, the archetypal cycle looks like this.
Interesting.
So the red line you can see is probably about to plunge, but it's hard to draw strong conclusions because it has been completely flat when it should have been up and down. It just didn't move. Okay, so maybe it will not move for longer. I don't know. Anyway, when I look at cycles, I do not expect the red line to behave just like the black one. What I am very attentive to is the turning points.
Right.
So what I can expect is that sometimes in 2025, possibly in the middle of the year or a little later, we should have an improvement in the US economy, in the US industrial production, and I assume therefore in the US economy. It will not last for long because, as you can see, in 2026 it turns down again, and this is the end of the cycle. So this is the most reliable part of the cycle. Okay, the middle of the cycle, the beginning and the end are really very important parts.
Yes.
So actually, also, I'm always very careful when I have strong moves up like this. It can be a reaction high to something that dropped very fast previously. You never know. Maybe not. Sometimes it's a real improvement. Sometimes there's a lot of reaction to something really bad that had occurred previously. So overall, it's for the immediate future, it's not yet good. Maybe it will improve, but it's yet to be proven. It depends how far down we go this year. So industrial production is not very satisfying either.
Right.
When I look at yields, um, we are just beginning a new 7-year cycle. And that's why there are three lines here. It's because I also mentioned when I am at the very beginning of a new cycle, I always mention the line of the previous cycle in gray. I have the average in black, the current cycle in red, and the previous cycle in gray, and the average in black, the current cycle in red, and the previous one in gray. And so, well, we don't have much room for US yields, 10-year yields. Be careful, because there are that many different scenarios that could see US 10-year yields rise.
Yeah. Actually, in the last few
And
days alone.
by September, at the latest, by September, US yield should rise. Maybe before that, I don't know, because it's just the very beginning of the cycle, and I assume that it would be 7 years, but maybe it won't. Maybe it will be shorter or a little bit longer. Anyway,
And on the point,
there's not much room for US yields to go down.
uh,
I didn't hear your question.
on that, on yields, one top of mind question, Valerie, is yield uh, extremes. I mean, not precise levels, but extremes, particularly on the upside. Do you see on this cycle model, and I know it's the timing and the pattern rather than the magnitude, but in an up cycle on yields on this work, do you see yields rising more than into 5% or more?
Oh, I have no idea. Oh, I mean, if I look at charts, yeah, more than 5%. Of course, yeah.
Yes.
It has to be more than 5%. And if we look here, you see the planned top for yields is late 26 to sometimes in 27.
Okay.
So it matches the inflation cycle, though they come from two different parts. I mean, there's absolutely no overlap in the identification of peaks and bottoms of yields and inflation. It's two separate works. So they match, but inflation is out of sync with this average. So we'll see. So, yeah, not an easy way on yields.
If I could share
The
one
Dow
chart with
Jones
you,
35-year cycle.
if I
Um,
if I could share one chart with you, Valerie, if the sound's okay, just this one on my side. Uh,
yes.
it's an analog, and the wonderful thing of analogs is they look good until they don't work. So, of course, they're a good reference for a historical rhyme.
Yes.
And this is the 1970s. CPI, the past CPI for in
Yeah.
red compared to here and now in blue. And what it shows is inflation halving from its peak levels as part of rolling waves of inflation volatility. The direction is difficult, volatility is clear, but the next wave is a resurgence up within the next 6 to 12 months if this analog plays out. So I'm wondering, Valerie, based upon your
Yeah,
view,
my average takes into account the previous cycle too. So we will have to see. We have to be attentive. It just tells you those cycles. They don't tell you it's going to happen. They tell you be aware that it may happen. So if you have indications that it's going to happen, believe it and go with it. But as long as it doesn't happen, be patient. That's how I use them. Because you don't know the future. You just have an idea of the rhythm that may be at work at the back. So
understood.
the Dow Jones 35-year cycle. was due for a fall. It's interesting also to remind you that those cycles, they usually rely on the either the last day of the month or the first day of the month. So it's only one quotation per month, whereas you have a lot more volatility within the month. So that's another thing that can be very tricky when you look at a cycle peak or cycle bottom. It's just that it does not tell you anything about what occurs during the month. Okay, and you can have a lot more volatility. Anyway, the end of March was rather low already for the Dow Jones. It would be even lower if I had added this month, the latest data, the data from the day before yesterday, 8th of April.
Okay.
Anyway, what should occur in 25 is that we should have a sort of recovery. As you can see, the black line goes up, and then we have a sharp bottom, but that sharp bottom is sometime in 2027. So 2020, before that bottom in 2027, we have a lot of 2025 and 2026. My interpretation is that this time is going to be building a top. Usually, the stronger the rally, the longer it takes to reverse. So what I have in mind is that maybe we will be in a consolidation for another year and a half. And that consolidation, so far, we have 20% top to bottom by the S&P. It's not very large. For long-term consolidation, we could easily have 50% top to bottom. Nothing surprising. So the recovery that we have ahead of us, I don't know what it will be like, because let me show you a few more charts. That's the 11-year cycle on the Dow Jones. So we are focusing on a little bit less than 1/3 of the beginning of the previous cycle. And here again, you see I've in purple here, I have a rectangle because I was saying to my clients, okay, in 2025, we will have volatility, but maybe not so much trend. Okay.
Yes.
And to stop the trend from rising, you first need a first shock. We've just had that shock. Okay, that first market drop, if it's over, its role is to put an end to most bullishness in the market. We may have another top from the strongest part of the market, like techs, US techs may reach another high. If there is another high that can be reached, it will be on US techs,
and just
technology sector.
Just to be clear, a new
But
all-time high, retest of the all-time high.
a new all-time high, or a little bit higher, but what we call a marginal high.
Okay, understood. So we could
some sectors will start. Yeah, that's it. But then this is the other cycle this is the same cycle, the same dates as the ones that, this is the exactly the same cycle as this one, but this one is a 12-month rate of change, and this one is a 6-month rate of change. And it looks very different, because as a 6-month rate of change, you can see that it goes down very regularly until sometime in 2027. Whereas as a 12-month rate of change, it may go up again. So that's why I think that we are already into the consolidation. When you are in the core, in the middle of a trend, actually all your indicators are pointing up. When you start to have divergences, and when you still have long-term momentum, but the short-term momentum begin to turn down, it means that you are consolidating. You're not in the trend anymore. So that's why I say we may have a marginal high on the strongest sector, but overall, for the index itself, for the S&P or for the Dow Jones, I think the top is in place.
Okay.
And
Clear.
when I look at my 6-month rate of change, I'm not even sure we will go back to a 62% retracement of the December to March fall. Okay, we had a correction from December high to end of March or early April, retracing 62% of that correction, maybe a little bit too optimistic.
Insightful and timely, Valérie.
I don't know. But right now, I'm very, very cautious on that. And this is my shortest cycle on the Dow Jones. It's a 3.5-year cycle. And as you can see, the 3.5-year cycle has been dropping very fast this time. The red line went down much lower than the black line usually does. And much earlier. So it's hard to know, because we don't have the perfect timing for a bottom from a cyclical point of view, from this cycle point of view. So we may need to test the bottom again or to go below yesterday's low. But for the time being, on my on my medium-term charts, what may happen between now and summer, I'm not sure we have had the bottom yet. Pausing tariffs may not be enough to end the market correction. Cycles can't say that it's over. Of course, we have another fall coming for 26-27, but even in the meantime, we may need to fall a little further. It's unclear right now. So those are the charts about today that I had prepared. Obviously, I did not know that the markets would be shaken like yesterday. It doesn't change much, because those cycles tell me that we are in a weak part. One of the big takeaways for me from cycles is that when my lines are rising, I expect the market to be more reactive to good news than to bad news.
Yes.
That's one of the interpretations I make. When my lines are pointing down, and when my lines, when my average line, okay? When my lines are pointing down, I expect the market to be more reactive to bad news than to good news. Because a cycle, basically what we know is that a cycle is something that arises from a crowd behavior. So a crowd behavior is pure sentiment. So those ups and downs that we see on any cycle teach us about how the crowd sentiment is evolving. Is crowd being optimistic and ready to go forward, ready to take risks. This is when the curve is rising. Or is the curve in a retreating mode? Is the curve, falling, and then the sentiment is shrinking, and people are being more cautious and more pessimistic as it goes? That's what I rely on. I think that it's the most important takeaway. It's how are events going to be interpreted, how macro events are going to be listened to and understood by the crowd. Because, listen, I've been on markets for 35 years, a berry cycle. And I've seen everything. I'm still surprised, but I've seen a lot. And nobody knows anything about the economy. Nobody knows anything about the future. No one, no one, not even me, right? I definitely don't know anything.
Probability is not certain.
And people who do fundamental, probabilities only. But people who rely on fundamentals, they can tell you the most stupidest stories. Like this year, I couldn't believe my ears when people were saying, "Oh, Trump, we know him. Trump, he will react to the stock exchange. He will never let the Dow Jones fall," as if a president could decide whether the stock exchange is going to go up or down. Nobody can decide that. The Fed cannot decide that. So definitely not Trump. And then they would say he's going to lower taxes, therefore it's going to be very good for the markets. Okay, but if he lower taxes, then yields are going to rise, yes, because we're going to have to handle a bigger deficit. And
Yeah.
people were ignoring completely, they were ignoring almost 3/3 of the macro pictures every time. All their scenarios were incomplete. And I
And now
wrote
we're
down
on
all the
tariffs.
potential scenarios, and I said, look, there's only a 5% chance for that scenario to unfold, for that all rosy, dreamy scenario. It has a 5% chance. Where are the 95%? And that's what I've learned. It's how do people, what matters is what people imagine about the future, what are their positions in the market, have they fully reflected their dreams already, or are they still building up their positions, their exposures? But when you know their dreams, when you can assess their positions, then you can be a contrarian. And you have to, and then you know that if the cycle turns down, even the smallest bad news is going to have a big downside impact. And I think that right now the market is the Dow Jones is in a stage where even good news will not be long lasting on the market.
You hit on an important point where
you have to be a contrarian on good news.
Contrarian on we're basically counterintuitively, good news is bad news and bad news is even worse than expected. But typically we're just in a
Yeah,
negative social
that's
mood.
the period now is like this. Like in 2023 it was the opposite.
Yes.
You really had to go with every small piece of good news would have a huge impact. uh, but now it's the opposite. So for me it's very useful. I don't know for the others, but for me it's very useful because if you combine that with technical analysis, if you have a breakout on technical analysis, for example, a new high with lots of volume and a very good news, I am very tempted to wait just a little bit and to sell that top because it's a period when I don't trust new highs. Whereas if we break a support, even if there's no news, I may add to my downside exposure. So that's very much how I also use cycles on my on a daily basis. It's to know whether I want to go with the trend or and how I use technical analysis, because technical analysis doesn't work in terms of forecasting. Technical analysis is only useful because it allows you to have stop losses that are the most efficient of all stop losses you can find. But apart from that, there are times when you have to go with the trend, and there are times when you have to go against the trend, and technical analysis is not able to answer that question. So to answer the question, shall I go with the trend or against the trend, I rely on cycles and sentiment.
Thank you, Valerie, for an insightful and timely discussion on cycles, your framework, and the practical application in a market situation as part of the work that you do for Day by Day. What is the best way for our viewers to stay in touch, follow your work for education purposes, or even in terms of the services of Day by Day?
Well, from our Day by Day website, people can. There's a contact, address that will lead you to me.